Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, February 25th, 2019. In this video, I want to take a look at the long-term charts of the markets and a handful of the market-leading stocks, those stocks that make up a vast majority of the returns, a big bulk of the returns out of the NASDAQ 100, and they also account for a significant percentage of the S&P 500, even though they're not as top-heavy weighted as in the NASDAQ 100. So I refer to those as the FAAMG stocks, FAAMG, because those five are the top five holdings. Netflix is down the rung. You know, again, everybody likes to throw in the N because it has an easier ring, comes off the tongue better. FAANG stocks. So either way, and I'm not going to look at Netflix because we can't go back. I want to look at the stocks that have been around for a long time. Look at the monthly charts, and there's some pretty clear technicals on there. Whether they're going to play out the way I still suspect that they will or not, again, that is, and I'm going to go over that. There's some bullish takeaways from some of those charts, and there's some bearish takeaways. And at the end of the day, I think what you'll get out of this video, whether you are from this point bullish on the markets going forward or you're bearish, I can at least highlight some key levels that you can watch that may change or reinforce your view depending on what happens. So let's start out here. This chart I've been focused on for the last week or so. It is the target that I had laid out at the end of last year, my maximum bounce target. If you recall in that video I did on December 31st, I had a range which pretty much was the bottom of this sideways trading range here to the top. So that was my minimum bounce target, which obviously has been hit and exceeded. And now we're at my max bounce target. And that max bounce target is one of really two things. It is if it's again, it's a target that may or may not hold, but it is if the bearish scenario plays out that the top in 2018 was indeed a bear market, and this was the first leg down, this is the first bear market rally, then that would quite likely be the stopping endpoint. The other thing is I'm still looking for what I was back here, a tradable correction, a pullback of 4, 5, maybe 6, 7, as much as 8% at this point, even if the market is going to new highs. So that would look something like this. So let's just say right now that this is my bullish scenario, and it still entails a correction. The stock prices have just gotten way ahead of themselves. Sentiment is, the readings are really starting to spike, and above all, this is a very significant resistance level. Whether it gets taken out without pause or not, what's happened in the last few weeks doesn't change what I think may happen now going forward. I recognize how resilient this trend is, as I mentioned lately, being a little extra cautious now on the new shorts, but very much open to the possibility of a sharp pullback and maybe even more coming up. Now, again, the point I'm trying to make here is these are significant reaction highs. This was an important trading range in that fourth quarter correction. We have 3 equal highs. So I think it would be hard to argue from a technical perspective that this is not a significant resistance level. So if we blast on through it like it isn't there, I would be surprised. I'll say that now. Nothing shocks me in the financial markets. I've seen a lot in the years I've been trading, but at the very least, you're probably going to get a reaction here. A lot of eyes are on that level. And again, I mentioned this before. If you pop above it a day or two, that's not really a big deal with the momentum you have carrying to the upside. 1 or 2 day close. What you don't want to see for the bearish case, which wouldn't help it, is some little consolidation here or pop above, and then we just continue on higher. In other words, if we put that level clearly in the rearview mirror, you're going to get very close to those 2018 highs. We're getting stretched now on this rally. The market, once it gets close to old highs, it likes to try to pop those highs, even if it's going to pop them and come on back down. So that's where we're at. And again, let's not talk on it too much. Resistance is resistance until unless taken out. That's just simple technical analysis. So we'll have to watch what happens here. And then we look at another board. I have a couple boards here. Bigger picture, you can see we continue to diverge right here. We have that trend line right there to watch. Again, this is a 120-minute chart, or aka 2-hour chart. Every candlestick is 120 minutes. And here's what the SPY is doing right now. All right. And before we get to those long-term charts, the monthly charts, pop out here to a daily chart. There's that same trend line. You can see the horizontal resistance line, those 3 reaction highs there from the fourth quarter rally. And if we even come all the way back here to that the advance of the kickback rally we had after the correction earlier in 2018, come off that reaction high, you can see we get another one right here. And they're all give or take, very close to that level. So there's a lot of resistance here, if you will, on the S&P 500. And again, with this extended run like this, to see this go on without a pause, this is already probably a Six Sigma event or close to it, as far as how it falls on a bell curve of probability. Statistically speaking, it's out there as far as a rally of this magnitude without a correction. Last time we saw anything like this, I believe what I read was early 2009 off the lows. And keep in mind, that came after a 55% bear market where valuations were extremely favorable, and prices were extremely oversold. This one's coming at the end of one of the longest bull markets in history, or towards that point. So again, we'll see what happens. Let's get off that. I've talked plenty on that now. Let's go out to the longest term charts. And okay, I've covered this chart a few times in the past. We'll just start out with the major large cap indexes. We'll look at SPY. I'll pull up S&P 500 for those of you that like to follow levels on the SPX, and then maybe QQQ. But this chart, speaks pretty clearly to me. It's clean, simple, not a lot of extraneous trend lines and annotations and other things. That what stands out, you have going back, this goes back a couple decades here, several decades actually, all the way back to the early 90s. And you have the previous bear market, bull and bear markets, I should say. This was the longest one in history. This one's coming right up to that point. And if it continues much longer, it will be the longest bull market in history. And that one was followed by a vicious bear market, you can see there. And so there's bull market number 1 top, bear market number 1, bull market top number 2, bear market number 2. And again, some pundits out there consider this period here where we had 2 years of sideways trading, and some indexes, small mid caps and other sectors entered a bear market. Call it what you want. But it was a year of sideways returns, and followed or interrupted with several pretty sharp corrections in there. So what stands out, you have, and I should have marked it up here. Let me add this line. I need to add a divergence line that disappeared for some reason. So the similar traits, and again, this really helps to formulate my longer term picture. And this is more. This is not actionable. These charts, I'm in the monthly charts now. Please understand this point with your trading or investing. These are not actionable for swing trading. You don't time an entry or an exit on a swing trade off a monthly chart. This is longer term, painting or formulating the longer term picture for investment funds, 401ks, and everything else. So again, you had what stands out, divergence. You can see the negative divergence at each and every high of those 3 markets. We had one here. And so you had bear market number 1. After that divergent high on the monthly chart, bear market 2, bear market 3, and if you want to call this little tiny blip a bear market, I mean, certainly some people will attach that label because we dropped over 20%. As I spoke about, that is simply a correction when you take it in context with the larger wave. Forget about the whole 20% thing. That is just a correction, as was this one if you look at it from that perspective as well, correction within an ongoing trend. You can clearly see the bear market. So again, you have the divergences. You can look down here. I'm only using 2 indicators. You can throw up other ones if you want, and you'll probably see the same. You can also see the old tried and true ROC12 is a trend indicator when it goes red. There's a few brief whipsaws. Sometimes I'll change the setting to an ROC13, play around with it. But we have two big red bars, and sometimes you get those little green kickback bars. And then most importantly, well, now let's look at price. So those are the indicators. Those are divergences. Those tend to foreshadow or help predict the scope of the move that may come after the trend reversal sets in. As I say often, divergences are not a sell signal. Whether they're bullish or bearish divergences are not buy or sell signals. They're merely an indication that an impending trend change is likely. And when you get them on the monthly chart, again, you're not talking a swing trade that might last a few weeks. You're talking a trend trade that can last several months or even years. And so that's that. Cover the divergences, and then of course you have the clean trend lines, and you have a moving average that I have up here. The 20-period exponential moving average does just a great job of defining trends, bull and bear markets. You can see nothing's perfect. You have a couple whips, although this was a bear market right there. Don't get me wrong. That was a drop of, I believe, 20% or more. If not in the S&P, you probably had it in some of the other indexes. So we cut under it there. But for the most part, it just does a phenomenal job of telling you, okay, this is a bull market. And then when you cross down below it, you're in a bear market. Rallies back to that level should act as a resistance, which they did here. Bear market, bear market. And again, it is not a timing indicator, neither. Nothing on the monthly chart is a timing indicator. It just helps to confirm the larger trend. So bull market, and you can see, you can go through it again. A couple whipsaws. We had a lot of volatility early in the this bull market off the lows, so a couple whipsaw signals, but for the most part, it's done a good job. And again, that was another period. So now what happens? Well, the month isn't over yet, so let's see what happens. We don't have a whole lot of trading left in the month, a few days, but let's see where this candle ends up. We took it out there, sliced below it, and we're back testing. So there's two things. We're going to give the bullish case a check mark as long as we're above this line on a monthly closing basis. So and that's what so far we have. This green candle right here means we closed above it for that month. We closed below it right there. So check mark for the bulls until and unless this trend line is taken out on a closing monthly basis. And then you have an uptrend line here, and I'm going to show you a couple more, which I think is pretty clean. I think captures the uptrend off the 2009 lows the best. You know, you had a lot of downside momentum. This is what I often refer to as a momentum-fueled overshoot. But you can see this is a green candle, this monthly bar. We closed back above it. That's where we closed. And when you come in, this trend line tends to capture the most number of candlestick tails, the skinny part, and or bodies. And that's what I like in drawing a trend line. So we're still below trend, coming up to back test now. So that's one perspective which you give a check mark to the bearish case, because this is simply a breakdown and a back test. So like I said, there are some mixed signals at this point, and I personally cannot say definitively, nor have I been able to for a long time. I think there's a lot of evidence that says this is likely a kickback rally in a larger bear market, but there's a few more things that need to be taken out with conviction, especially in these long-term charts, to say that. All right, so SPX, look at another perspective. Same trend line, really. Very similar, and we're popping above it just barely. Again, these are monthly sticks. All that's going to matter is how this closes here in a few days. But there it is. So you can see we're currently roughly back testing the trend line there. I'll just show you. I'll flip to different boards. This is a trend line I believe is very significant. I've covered it quite a bit on daily and weekly charts. It's a trend line that comes off the early 2016 lows, and that was very well defined. A lot of clean reactions on it. Breakdown, back tests, and we rolled over impulsively. So by that one, we're still well below trend. And then finally, QQQ. Now we can play around with this trend line. The Q's bottomed back. It's the only index or major index that bottomed back in late 08. But roughly, we'll call it, for all intents and purposes, everything else bottomed back in March 2009. That's where this bull market officially started. So we'll go off that one. Now, two draws. I'm going to give you the, again, I'm trying to look at this through, a clear objective lens. So this draw comes right off that candlestick low, comes in nice and captures. Again, it's okay to have these intra-month pierces. That's more than common. This is how I draw trend lines on any time frame. You have the maximum number. Again, it's an art, not a science, but I like to go for the maximum number of candlestick shadows. That's the skinny part on the bottom, aka a tail when it's on the downside, and or bodies. So we have a lot of reactions there. It comes in clean, and you can see a breakdown, and we're still below there. So that one, by that trend line at least, check mark to the bears. The divergence high says that there should be much more to come, that's not just a regular blip or a pullback. Now we can pull this trend line out a little bit and come in, and let's do it like this. Let's do what I call the BOD, or benefit of the doubt trend line. So we come in a little low. We start off that reaction low back in late 2008. We come in there. As you can see, I'm not touching as many candles. And so if you want to have this as a benefit of the doubt trend line, meaning if and when this one goes on a monthly basis, I think with a very extremely high degree of probability that it's safe to say that the markets are going on to a bear market. I mean, if you think about it this way, if we come back down below there, we're going to be close to testing the recent lows. There's the lows from last quarter. So if we break that trend line, especially close below it on a monthly basis, you're going to get pretty close. It's going to look pretty ugly. And if we get anywhere close to those lows, I highly suspect you will get a waterfall sell-off if we get there. So there's a couple views. And then you can see the old tried and true 20-month EMA doing a great job of defining the bull market up to the 2000 dot-com bubble. I told you if you weren't already out, get out then. You're in a bear market. Told you back here, bull market. And again, it's done a good job of defining the trends when prices are below. There's the '08 bear. Doesn't look like much compared here because there was such a crash in the dot-com and in the tech-heavy stocks, tech-heavy QQQ that is, that it makes the 55 or so % drop from the last bear market look like a minor blip on the radar. So keep that in mind. That was a pretty significant level. Told you since. Look how well that, and look at just the bodies. Don't focus on these intra-month candles. Look at the bodies, and it's just done a great job. So we broke it, but we snap back above it. So again, mixed signals there, and benefit of the doubt trend line, that needs to go. And if you look at it the way I had it before, tighten it up a little, catch more of those bodies. We're back testing it now. So glass half empty or glass half full, however you want to view that. Okay, and now on to the again, a handful of leading market leading stocks, largest components of the NASDAQ 100, and most of these also largest components of the S&P 500. This chart again is clean, doesn't have a lot of trend lines or markups, and it speaks volumes to me. You can see that I've taken the time. I've shared this many times over the years. Here's all your bull and bear markets, or the bear markets, I should say, in Apple, and you can see how much they were, and the drops are measured from the highs to the lows, as they should be. And these may not look like much, but they're significant drops. Apple is powerful on both trends, on the way up and the way down. So last one we had right here was a 34%. And again, the catalyst are these uptrend line breaks. They're pretty clean uptrend lines. You can view them all there. And again, let's fast forward to today. We had not only that trend line break, but we also had, from a longer term chart, and that's what we're looking at here, long-term charts. Apple's been diverging for a while, but I won't even pay attention to the divergences right now. Let's just use these two simple trend indicators, that trend line breaks. And again, if you just take a look at those past trend line breaks and look, in each and every one, you had a kickback rally. No, I'm sorry, I shouldn't say that. Not in each and every one, but sometimes you do get kickback rallies like you had here. You had a nice clean sell signal, kickback rally, and then boom, from where we peaked, which wasn't far below there, 70% drop. So sometimes you get the kickback rally. Here's another one. Broke the trend line, had a kickback that almost retraced all the move. That was at least a 61.8 Fibonacci retracement there. I can just tell by eyeballing it. And then sometimes you get them, sometimes you don't. So far, as you can see, we're still well below the trend, and that was a pretty clean trend line, broke down, and so far the drop on that initial leg was 39%. Apple's not even back testing, so Apple, from that perspective, and let's look at a couple other things down here. Let's look at this ROC12. It's also done a great job of confirming trend changes. You can see here they're flattened out, but there's the red. There's the red. I'm circling the red areas. There should be some type of adjustment made to this, but there's not. But you can see the red areas denote bear markets. It's a trend indicator, and it's pretty darn consistent. If you stayed long when this was green, I'm not telling you to use any one signal or indicator, but it does help show you the bull and bear markets. It does a good job of, if you follow the line up, getting you out not at the very top, but not too far after that. You can see there if I'm doing that properly. And here we go. So we've had red bars since the breakdown. And by that indicator, it's saying, as of now, under trend, below trend, with the ROC12 histogram negative red, also below that 20 EMA that's just done a great job of defining the uptrends and downtrends. So bull market, bear market. So 3 check marks for the bearish case on this one, and 0 right now for the bulls. Okay, here's Amazon. Here's a long-term trend line, comes all the way back to the late 90s. Pretty well defined. This is our secular bull market uptrend line. So Amazon, by all accounts, is still clearly above this. I think there's enough reactions along the way to make that trend line valid. This is our, we'll call it this, our secular bull market, or at least the uptrend line. Let's not try to label it too much. Let's just say that is the trend line. As you can see, that comes off about early 2015, late 2014. Enough reactions when we zoom in tight. 1, 2, 3, 4, and then the breakdown 5. So we'll move that down. Just I like it where it is. It's capturing those reactions. So you can see Amazon trading below that trend line, but it's still above its 20 period EMA. So check for the bears on the trend line break and the fact we're still below that trend line. Check for the bulls that we're still above the 20 EMA, so those are levels to watch. And longer term target would be a natural target would be that longer term trend line. So for the next leg down, if we get it anytime soon, that should be a target. But like everything else, I'd want to correlate that target with other targets on the daily and or weekly time frames. Okay, and here's Alphabet. This is Class A, GOOGL, the symbol. On that one, I have a trend line here. Let me just pull that in a little tighter there. This share class, I have a clean trend line. I don't think anyone can argue that trend line. We don't even have so much as a candlestick shadow or tail, piercing through there. Lots of reactions along the way. Remember, Alphabet hasn't traded as long as those other stocks that only came public back here. What was that, 04? So we can only go back that far. Yet, here's a trend line. This is the entire bull market low. I think it's hard to argue that this is a valid trend line, and we're trading below it. However, we're also above that 20 period EMA. Remember, if you look back and you're watching this video and you haven't seen my other videos, trend indicators are useless. And stay away from them. You will get chopped to pieces trying to trade off them or trying to extract any useful value during a trending market. I'm sorry, a trendless market, a sideways market, choppy market. So you want to look for clear trends when using at least these slower moving averages on longer term time frames. And as such, it's done a great job of defining those the bull and bear markets. And so that one, again, check for the bulls there, something to watch more importantly, and check for the bears on the breakdown and the fact we're still below on Alphabet. Now the other share class, GOOG, I have a slightly different draw coming in here, as you can see. Still catching a lot of reactions. We're right on it, so you have to give the benefit of the doubt until you've broken down on the current trend. So 2 checks for the bulls because you're just above. You've been testing that 20-month, and you're still above trend on that share class. Facebook also hasn't been trading very long. Facebook only came public, was it back in 2012 or so. So this is our long-term trend line. It's not a lot of reactions. Again, you don't have a lot of chart history to go off of, but I think there are enough that started back there, and we recently tagged it here. So we're above it. Even then, it hasn't traded long, but you can see once the trend kind of got going and normalized, remember, it was very choppy and erratic after the IPO. And then since then, the 20 did a good job. So we came up, we broke below it, 1, 2, 3 months below it. This one, for all intents and purposes, although it closed a hair above it, that's not, it didn't take it out with conviction. So in my book, that's a close back on it, and we're trading on it now. Technically we're a hair above it. Let's see how we close the month. It would take market would have to take a pretty good leg down in the remainder of this week to get some of these back below there. But so we'll just call that for this point in time, a check mark for the bulls because we're above that trend line. Again, I don't give it the highest weighting just because we only have a few reactions. And the 20, we'll just put if I could draw a little question mark there. But for now, since we're slightly above it, we'll give that one to the bulls. Okay, now I was going to wrap it there. Those are the big 5 FAANGs. And I'll just rifle through a couple of these quick. You can then stop the video if you want and analyze the charts. And again, look for the levels of trend lines, any levels. I'm just going down what I didn't mention before. I'm going down the list of the holdings of QQQ sorted by market cap. So as you go down the list, you can see, Apple's a $800 billion company. You get down to number 6, Intel, it's only $234 billion, and as such, it has a much lower weighting. You can see that the market caps quickly drop off. So when you're down here to the top 20th holding or so, they represent, at least by market cap, they're only 1/8 of the big guys like Apple and Amazon, and they also likewise they have a much smaller impact on the index because their weighting is much smaller. But to get a bigger picture, because the top 5, although I focus on those as being the market leaders, top weighted index, and they give us a good clue to what the market's going to do or doing. But when we run down the list here, and I'll just do that now, there's Intel. You can see above trend line and above the 20-month moving average. So is Cisco above both right now, so that's good. Comcast has broken down a clean below trend line and has been flirting with that 20-month. So that one, check for the bears and a check for the bulls, we'll call it. Pepsi below well-defined trend line, also struggling to hold on to that 20. So there's a question mark there. Netflix. Don't have a lot of price history to go off of, but here's a trend line we're above and above that 20 months. So that one's okay for now. Adobe, again, you can just replicate these. And what I do is I watch these. If depending on where we go from here, if we do have another leg down and all these trend lines and all these 20 EMAs are getting taken out, that will further reinforce the case that we're in a new bear market. But while we have a lot of these still above trend like this and testing these trend lines, again, the evidence just isn't there yet to say that's what this was, that it was anything more than a correction. All right, so we'll wrap it up here. I'll leave it with NVIDIA because I could go down the line, but then again, the weightings become much smaller. Some of these charts I don't even have annotated, but you can draw. You can clearly see a trend line on Costco there, and so that one's above trend as well. But as I do wrap it up now, divergences on a lot of these stocks that say it's probably only just a matter of time. There's not any trend in the market that lasts forever. And so if you just draw these trend lines, watch for the breaks, watch for the moves back below that 20-period EMA. And at that point, if you have long-term funds in the market, 401ks, IRAs, that type of stuff, this is where the takeaway. This is where I think you'll find value in these long-term charts to position to get out of the market, not just for a few weeks, but for a few months, possibly a few years. And we will wrap it up here. This has been Randy Finney with Right Side of the Chart, and I hope you enjoyed it.